The balance sheet starts shrinking next month. Fed officials have lowered their inflation forecast, but they still see one more move this year and 3 next year. Those are the headlines. The dot plot compresses, with fewer seeing higher rates going forward, and at least one policymaker joining Jim Bullard in predicting no rate move next year. But the median doesn't come down until 2019, with 2 moves forecast, and the terminal rate, the neutral rate, moves down over the long run to 2.8% from 3%. Core inflation is expected to rise just 1.5% this year, and next year headline PCE inflation 1.9%. That's a decline from a 2% forecast in June. Unemployment falls to 4.1% for the next 2 years, but the long-term level of inflation, full employment, remains 4.6%. In their statement, Fed officials suggest the hurricanes won't have a long-term impact on the overall economy. Quote, Hurricanes Harvey, Irma, and Maria have devastated many communities, inflicting severe hardship. Storm-related disruptions and rebuilding will affect economic activity in the near term, but past experience suggests the storms are unlikely to materially alter the course of the national economy over the medium term. They will affect prices, however. Quote, higher prices for gasoline and some other items in the aftermath of the hurricanes will likely boost inflation temporarily. Apart from that effect, inflation on a 12-month basis is expected to remain somewhat below 2% in the near term. The Fed keeps its promise to monitor inflation closely, but they do say it will come back to the target. And as for the tapering, as expected, starts next month with mortgages. Their announcement will be on October 9th, and the retiring treasuries will be announced as of October 31st.